Hello financial fans, welcome back to another stock analysis. Today we'll be covering the Walt Disney Company stock ticker DIS. The Walt Disney Company is a multinational entertainment company that operates in various segments of the entertainment industry. The company was founded by Walt Disney and Roy Disney in 1923 and has since grown to become one of the largest and most well-known entertainment conglomerates in the world. Disney is primarily known for its motion picture and television production, as well as its theme park and consumer products. The company produces a wide range of films, including animated and live-action movies, under various studios such as Walt Disney Animation Studios, Pixar Animation Studios, Marvel Studios, and Lucasfilm. These films are distributed through various channels such as theaters, home video, and streaming services. In addition to its film production, Disney operates several television networks, including the Disney Channel, ABC, and ESPN. These networks produce a variety of programming ranging from children's shows to sports broadcasts to primetime dramas. Disney is also known for its theme parks, which include Disneyland in California, Walt Disney World in Florida, and various other parks and resorts around the world. These parks feature a range of rides, attractions, and entertainment experience based on Disney's popular characters and franchises. Finally, Disney operates a consumer products division that produces a range of merchandise and licensed products based on Disney's various brands and franchises. These products include clothing, toys, books, and other merchandise sold through various retail channels. They are currently sitting at a $168.9 billion market cap, and in 2022 they generated a revenue of $82.6 billion. 33% of the revenue comes from parks, experiences, and products, 21% from media networks, 17% from studio entertainment, 12% from broadcasting, and the remaining 17% from direct-to-customer products. To determine the final valuation of the company, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health, and the growth of the company, and will be using a standard margin of safety of 20%, which can never be below 0%. The margin of safety can either increase or decrease by the ratios that we're going to look at in just a moment, and the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in a scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction from a margin of safety. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction. The first two metrics that we'll be looking at are the EBIT growth and the margin growth. The EBIT has gone down over the years, going from almost $9.5 billion in 2013 to $6.8 billion in 2022. The EBIT growth was still 5.5% however, which doesn't qualify for a margin of safety deduction, so no change in the margin of safety on this metric. The margin has also gone down, going from almost 21% in 2013 to 8.26% in 2022. The average decline was 3.3%, meaning a 5% increase in the margin of safety. The final two ratios are the debt to EBITDA and return on invested capital. To get a debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debts. For Disney, this is over 3 years, in this case a 333% debt to EBITDA ratio, which is a 5% increase in the margin of safety. The return on invested capital for Disney is sitting at a very low 2.5%, which is no change in the margin of safety on this metric. Let's go look at the valuation models next to determine the intrinsic value of Disney. The first valuation model that we'll be using is the discounted cash flow model. I've imported the free cash flow of Disney going from 2014 to 2022. You can see in the free cash flow numbers that there was a big drop in 2018 to 2019. This is something we'll get back to in just a moment. But the average growth rate during these years in the free cash flow was on average 11.11%. And in this case, I've adapted the discounted cash flow model just a little bit, including a short-term growth and a long-term growth. The short-term growth will be for the first 5 years and the long-term growth will be after. Because the free cash flow of Disney has dropped significantly, I've decided to put the short-term growth as 55%, which means that I think in 5 years they can get back to their old free cash flow numbers, as you can see here, going to $9.5 billion again. and then the long-term growth of the years after that will be sitting at 12%. With these percentages, we have determined the future free cash flow for Disney and determined a terminal year of valuation using a perpetual growth rate of 3% and a discount rate of 8%. This gives us a total sum of free cash flow of $188.2 billion, and to get an equity value, we have to add the cash and equivalents and subtract the debt, leaving us with an equity value of $148.3 billion. All we have to do to get our intrinsic value out of this model is to divide it by the amount of shares outstanding, giving us a discounted cash flow price per share of $81.04, which is a 12.71% downside out of this model. The second model that we use is Graham's revised valuation formula. In this model, in this case, we look at the forward earnings per share of Disney, the growth rate estimate projected by Wall Street, and the current yield of AAA corporate bonds in relation to the average yield AAA corporate bonds sitting at 4.4. And we go by the theory that a company with no growth is always sitting at a PE of 7. Looking at all of these metrics, we get a fair value of $86.91, which is a 6.39% downside out of this model. The third model that we use is the multiple valuation. In this model, we look at similar companies to Disney, and in this case, we look at the forward PE multiple of these companies. And in this case, on average, it's sitting at 22.29. Then, to get our fair value out of this model, we have to multiply by the forward earnings per share of Disney, which is sitting at $4.13 per share. Then we get a fair value of $92.04 out of this model, which is a 0% or 0.86% downside. And the last model that we will be using is the mean reversion theory. In this model, we go by the theory that a company will always trade above or below its mean. And the metric that we use to determine this is the PE ratio. In this case, I've imported the PE ratio of the past 5 years, and on average, it has been sitting at 55.52, while the current PE ratio is sitting at 54.99, indicating that it's currently just a little bit cheaper than on average of the past 5 years. This gives us a fair value of $93.73, which is a 0.96% upside out of this model. If you want access to all of the models that I use in my videos and more, you can check in the description for my Patreon link. Anyways, gonna get self-promotion out of the way, let's go look at our final overview of our valuation next. Looking at our final overview, we've imported the discounted cash flow, Graham's valuation, the multiple valuation, and the mean reversion theory price per share, giving us an average price per share of $88.43. Without a margin of safety, we would get still a downside of 4.75%, but we have determined our margin of safety earlier, using a standard margin of safety of 20%, adding 5% for the debt to EBITDA, and adding another 5% for the margin growth, giving us a 30% margin of safety. Applying this margin of safety, we get a fair value of $61.90, which gives us, with the current price of $92.84, a very large up or downside rather of 33.33%, indicating that it's currently a sell. If there's any other companies that you would like to see me cover on this channel, please let me know in the comments, and thanks for watching.